Why do founders demand rigorous financial justification for a $10,000 stock market investment, yet will spend $50,000 on a new company initiative based on nothing more than a gut feeling? As a founder, you are the first and most committed investor your business will ever have. You invest not just your money, but your time, your energy, and your passion. Yet most founders operate with a dangerous blind spot. They are brilliant creators, marketers, and visionaries, but they are often poor capital allocators. They make financial decisions based on emotion and gut instinct, not on the cold, rational logic of an investor. This book is designed to change that. It will provide you with a powerful new mental model to think of your business not as your baby, but as the primary asset in your investment portfolio. You will learn to view every dollar not as an expense to be managed, but as a unit of capital to be deployed for the highest possible return. The Founder's Wallet: How to Think Like an Investor in Your Own Company, written and published by Success Attraction Formula. Chapter 1: Viewing Your Company as an Investment. Imagine you have saved $100,000 in cash. You have a critical decision to make. You could invest it in the stock market, hoping for a steady return over time. You could purchase a piece of real estate, seeking appreciation and rental income. Or you could invest it directly into your own growing company. Which of these options is the best use of your capital? Which one offers the highest potential return for the level of risk you are taking? And most importantly, how would you even begin to answer that question with any degree of objectivity? For most founders, this last question is impossible to answer, because they are psychologically incapable of viewing their own company as just another investment option. This is the heart of the problem, a powerful cognitive bias we can call the founder's passion. You are emotionally attached to your business. It is your creation, your identity. This passion is a powerful engine for getting a company off the ground, but it becomes a dangerous liability when it comes to making financial decisions. The passionate founder makes choices based on what feels right, not on what the numbers dictate. They pour money into a beautiful new office because it boosts their ego, not because it generates a return. They refuse to cut losses on a failing pet project because they are too emotionally invested in the idea. They see the money in the company's bank account as a resource to be spent on operations, rather than as a pool of precious capital to be invested for growth. This mindset inevitably leads to wasted resources, poor profitability, and a business that struggles to achieve its full potential because its capital is being consistently misallocated. The transformative solution is to consciously create a mental separation. You must learn to wear two distinct hats. The first is your founder hat. When you wear this hat, you are the visionary, the creative force, the passionate leader who inspires your team and delights your customers. This hat is essential, but you must also learn to put on your investor hat. When you wear this hat, you are a different person. You are cool, detached, analytical, and ruthlessly rational. Your only goal is to allocate the company's limited resources, its money, time, and attention, to the opportunities that promise the absolute highest return on investment. The core mindset shift is to view your company not as an extension of yourself, but as the single most important asset in your personal investment portfolio. Every single financial decision, from hiring a new employee to buying a new piece of software, must be filtered through this powerful investor lens. The question must always be, if I deploy this unit of capital here, what is the specific, measurable return I expect to get, and is this the best possible return I can achieve compared to all other available options? This simple but profound shift in perspective is the key to unlocking intelligent, scalable growth. It transforms you from a passionate operator who is simply running a business into a disciplined capital allocator who is actively building wealth. To master this mindset, you must first understand the fundamental differences between the founder's perspective and the investor's perspective. The founder falls in love with products, ideas, and the process of creation. The investor falls in love with positive cash flow, high margins, and growing enterprise value. The founder often suffers from the sunk cost fallacy, continuing to pour resources into a failing project because they have already invested so much. The investor understands that past investments are irrelevant. The only question that matters is, what is the best use of the next dollar? The founder hates to abandon an idea, seeing it as a personal failure. The investor cuts losses without emotion, understanding that it frees up capital for more promising ventures. The founder thinks in terms of spending and expenses. The investor thinks in terms of capital deployment and investment. Learning to recognize which hat you are wearing in any given moment is a critical skill. When you are brainstorming a new product, wear your founder hat and let your creativity run wild. But when it comes time to decide whether to fund that new product, you must take off the founder hat and put on the cold, hard investor hat. A crucial concept that the investor-minded founder must master is opportunity cost. This is a simple economic principle that states that the cost of any action is the value of the next best alternative that you have given up. Every dollar and every hour you invest in Project A is a dollar and an hour that you cannot invest in Project B, Project C, or Project D. The typical founder only asks, is Project A a good idea? The investor-minded founder asks a much more powerful question. Is Project A the absolute best possible use of these resources right now, compared to every other opportunity available to us? This creates a competitive environment for capital inside your own company. Every initiative must prove its worth against all other potential initiatives. This discipline forces a level of strategic clarity and prioritization that is impossible to achieve when you are simply funding ideas one by one as they come up. It ensures that your most precious resources are always flowing to your most promising opportunities. Let's look at a practical example. A founder of a growing e-commerce business has a $50,000 cash surplus. How should she use it? Wearing her founder hat, she has several exciting ideas. She wants to completely redesign the company website to give it a more modern feel. She also wants to lease a trendy new office space to improve company culture and make her feel more successful. These are emotionally driven decisions. Now she takes a breath and puts on her investor hat. She analyzes the options as distinct investments. Investment A is the website redesign. The ask is $40,000. The potential return is a possible 10 to 15% increase in website conversion rates over the next year, which she calculates might lead to $20,000 in additional profit. The ROI is decent, but not spectacular. Investment B is the new office. The ask is an extra $5,000 per month in rent, or $60,000 per year. The return is intangible, a potential boost in morale and maybe easier recruiting. The financial ROI is impossible to calculate and likely negative in the short term. Investment C is to hire a top-tier digital marketing specialist focused on customer acquisition. The ask is an all-in cost of $50,000 for the first 6 months. Based on her data, a specialist of this caliber could realistically acquire enough new customers to generate $100,000 in new profit within that same period. The ROI is a clear 100%. The investor-minded founder, looking at these three options, makes an easy, unemotional decision. She scraps the website redesign and the new office for now and immediately invests the $50,000 in hiring the marketing specialist, as it offers the highest, most measurable, and most certain return. That is the investor mindset in action. Once you adopt this powerful new lens for viewing your business, the logical first step is to conduct a clear-eyed, objective assessment of what you are actually investing in. How do you look at your own company with the cold, analytical gaze of an outside investor? How do you move beyond your own biases and get a true picture of the asset you are managing? In the next chapter, we will provide the framework for doing just that. We will walk through the process of conducting an investor-grade audit of your company's true assets, its hidden risks, and its most powerful, untapped opportunities. Remember to subscribe to Success Attraction Formula, give this video a like, and comment with your personal opinions or suggestions for channel development. Chapter 2. Auditing your assets, risks, and opportunities. Before a savvy investor commits a single dollar to a company, they do not simply look at its products or its marketing materials. They perform a rigorous and exhaustive process of due diligence. They scrutinize the company's financial statements. They assess the quality of its management team. They analyze its competitive position within the industry, and they look for any hidden liabilities or fatal flaws. They turn over every rock to get a clear, unvarnished picture of the investment. Why then, as the founder and primary investor in your own company, would you not apply the exact same level of rigor? The fundamental problem is that most founders are unable to see their own business objectively. They are too close to it, too emotionally invested. They tend to have a subjective and often overly optimistic view of their own creation. They naturally focus on the strengths they are proud of, their great product, their passionate team, while unconsciously downplaying or ignoring the very real risks and weaknesses that an outside investor would spot in an instant. They operate without a structured, holistic understanding of their own enterprise. They are, in essence, investing blind, without a clear and honest map of the terrain. This lack of a formal, objective assessment is a massive liability. It prevents you from seeing emerging threats until it is too late and causes you to miss powerful opportunities that are hiding in plain sight. The transformative solution is to schedule and conduct a formal investor's audit on your own company at least once a year. This is a structured process that forces you to step out of your day-to-day role as the operator and into the detached, analytical role of a prospective investor. The goal of this audit is to create a clear, honest, and comprehensive State of the Union document for your business. It is your internal due diligence report. This document will systematically outline your company's true assets, not just the ones on the balance sheet, its most significant risks, both internal and external, and its most promising, high-leverage opportunities for growth. Completing this audit provides the essential, foundational clarity required for all intelligent capital allocation decisions. It replaces your subjective feelings and biases with an objective assessment of reality. It is the process of creating the map that will guide your investment strategy for the coming year, ensuring that your decisions are grounded in a deep and honest understanding of your business as it truly is. The investor's audit consists of 3 distinct parts. The first part is a comprehensive audit of your assets. When most people think of assets, they think of the tangible things a company owns, like cash in the bank, inventory, and equipment. These are important, but for most modern businesses, they are not the most valuable assets. The investor-minded founder must look deeper and identify the company's intangible assets. These are the powerful, often invisible competitive advantages that are difficult for others to replicate. Your list of intangible assets might include your company's brand reputation and the trust it has built with customers. It could be your proprietary technology, software, or unique operational processes. One of your greatest assets is often your customer list itself, a captive audience that you can market to at a very low cost. Other intangible assets include the unique skills and knowledge of your team, strategic partnerships you have cultivated, or a strong and positive company culture that attracts and retains top talent. You must list these assets and make an honest assessment of their strength. An investor looks for businesses with durable, hard-to-replicate assets because these are the sources of long-term, defensible profits. The second part of the audit is a brutally honest assessment of your risks. This is often the most difficult part for a founder, as it requires confronting uncomfortable truths. You must actively search for what could harm or even destroy your business. It is helpful to categorize these risks into 2 buckets, internal and external. Internal risks are factors within your control. This could include key person dependency, where the entire business relies too heavily on you or another single employee. It could be a lack of documented systems and processes, leading to chaos and inconsistency. It could be poor cash flow management, a toxic company culture, or a failure to innovate. External risks are factors in the wider world that you do not control but must be prepared for. This includes the emergence of a new, disruptive competitor, changes in technology that could make your product obsolete, shifts in government regulation, or a broad economic downturn. You must list these risks and then for each one, make a realistic assessment of its likelihood and potential impact. An investor does not expect a business to have no risks, but they do expect the leadership to be aware of the risks and to have a plan to mitigate them. The third and final part of the audit is an expansive exploration of your opportunities. Where are the highest potential, highest leverage areas for future growth? This should not be a vague, scattered brainstorm. The goal is to identify specific, concrete, and actionable initiatives. These opportunities can often be found by looking at your existing assets. For example, if you have a strong brand and a loyal customer list, a powerful opportunity might be to launch a new product or service specifically for those existing customers, a far easier task than finding new customers for your existing product. If you have a unique, highly efficient internal process, an opportunity might be to productize it and license it to other companies. Other opportunities could include expanding into a new geographic market, acquiring a smaller competitor to gain market share, or shifting your business model. For instance, by creating a recurring revenue subscription for a product that was previously sold as a one-time purchase. For each opportunity, you should write a brief description of the concept and a high-level estimate of its potential impact. Let's look at an example. A founder of a successful local landscaping company decides to conduct his first investor's audit. For his assets, he lists his fleet of trucks, but more importantly, he identifies his real intangible assets. A highly skilled and loyal team of employees, a stellar 5-star reputation on local review sites, and a recurring maintenance contract with the city's largest office park. For his risks, he identifies his dependency on that one large contract, which accounts for 40% of his revenue, customer concentration risk, and the rising cost of fuel, external market risk. For his opportunities, he brainstorms. Based on his team's skills, he could expand into high-margin landscape design and installation, not just maintenance. Based on his reputation, he could create a premium, organic lawn care package for residential customers willing to pay more. And to mitigate his risk, he sees an opportunity to launch a targeted sales effort to secure more large commercial contracts, reducing his dependency on the single office park. In a single afternoon, he has created a clear, strategic document. He now sees his business not just as a collection of daily jobs, but as a portfolio of assets, risks, and opportunities that he can actively manage as a strategic investor. With a clear, honest, and comprehensive audit in hand, you now have a menu of options. You have a list of assets to leverage and protect, a list of risks to mitigate, and a list of specific opportunities to pursue. The next question is the most critical one an investor ever asks. Now that I know the landscape, where do I put my capital to work? How do you decide between a dozen good ideas to find the one that will deliver the absolute highest return for your business? In the next chapter, we will explore the art and science of disciplined capital allocation. Remember to subscribe to Success Attraction Formula, give this video a like, and comment with your personal opinions or suggestions for channel development. Chapter 3. Allocating Capital for the Highest ROI. Every single dollar in your company's bank account is a soldier awaiting orders. Each hour of your team's time is a unit of precious, finite energy. As the leader, you are the general, and you must decide where to deploy these resources. You can send your soldiers on a dozen different missions to develop a new product, to enter a new market, to improve an internal process, or to hire more people. The fate of your enterprise rests on these decisions. How do you choose which mission will lead to victory and which will lead to a costly defeat? This is the challenge of capital allocation, and it is the single most important job of the investor-minded founder. The problem is that most founders are not disciplined capital allocators. They are passionate operators. Having identified a list of exciting opportunities, they tend to deploy their resources, their money, their time, and their focus based on what seems most exciting, what they are most passionate about, or what feels most urgent in the moment. They often fall into the trap of peanut buttering their resources, spreading them thinly across many different projects, hoping that something will work. This lack of a disciplined allocation framework is the primary reason why so many businesses with great potential ultimately fail to achieve it. They are busy funding activities, not methodically investing in returns. They are sending their soldiers on a dozen uncoordinated missions with no clear sense of which one truly matters. The transformative solution is to begin thinking and acting like the manager of an investment fund, where you are the sole limited partner. You must adopt a rigorous, data-driven, and unemotional framework for evaluating every potential investment of time and money, and then deliberately allocating your limited capital only to those opportunities that promise the highest and most certain return on investment, or ROI. This mindset is a radical departure from the way most founders operate. It transforms the act of spending from a reactive, expense-driven activity into a proactive, strategic investment process. It forces you to make conscious, deliberate choices and trade-offs about where to focus your energy. It ensures that every soldier in your army is deployed on the most critical, highest impact mission possible. This discipline of capital allocation is what separates the companies that achieve explosive, profitable growth from those that stagnate in a state of busy but unproductive motion. It is the core function of the investor-minded founder. To implement this framework, you must first create a standardized way to evaluate every potential initiative that came from your audit in the previous chapter. For every project, whether it is mitigating a risk or pursuing an opportunity, you must create a mini investment thesis. This thesis must clearly answer two questions. The first question is, what is the ask? This is a clear definition of the resources required. How much money will this project cost? Even more importantly, how many hours of your time and your key team members' time will it consume over what period? Time is your most valuable and scarcest form of capital, and it must be accounted for. The second question is, what is the return? This is a specific, measurable, and time-bound definition of the expected outcome. A good return statement is not vague, like improve marketing. It is precise, like generate 150 new qualified sales leads within the next 6 months, or reduce customer support tickets by 25% by the end of the quarter. The return could be direct financial profit, cost savings, new customer acquisition, an increase in customer lifetime value, or the mitigation of a critical business risk. The key is that it must be defined in a way that you can measure. Once you have defined the ask and the return for each potential project, the next step is to calculate a rough return on investment. For projects with a clear financial outcome, the calculation is straightforward. The gain from the investment minus the cost of the investment, all divided by the cost of the investment. For example, if a $2,000 investment in a marketing campaign is expected to generate $10,000 in new profit, the ROI is 400%. For non-financial projects, like mitigating a risk, you can develop a simple scoring system. You might rank projects on a 1 to 10 scale for their strategic importance or their impact on the business's long-term health. But ROI is only half of the picture. An investor knows that a high potential return is worthless if the probability of achieving it is low. Therefore, the next crucial step is to assign a certainty score to each project, again on a simple 1 to 10 scale. This is an honest assessment of your confidence in the project's assumptions. How likely is it that you will actually achieve the projected return? A project to sell a new service to your existing loyal customers might have a certainty score of 9, while a project to enter a completely new foreign market might have a certainty score of 3. This forces you to distinguish between a solid investment and a speculative gamble. The final step is to rank your opportunities and allocate your capital. Create a master list of all your potential initiatives. For each one, you now have a projected ROI and a certainty score. You can combine these to create an overall investment score for each project. Now rank the entire list from the highest score to the lowest. This ranked list is your strategic roadmap for the coming year. You begin at the top of the list and allocate your capital, your money, and your team's focus to that number 1 priority. Then you move to number 2, and so on, until your available resources are fully committed. Any project that falls below that line on the list does not get funded. It does not get any of your time or attention. This is a ruthless and objective process. It forces you to say no to good ideas in order to say yes to the absolute best ideas. It ensures that your capital is concentrated where it can make the biggest impact. Let's return to our landscaping company owner. From his audit, he has 3 top opportunities. 1. Launch a high-margin landscape design service. 2. Launch a premium organic lawn care package. And 3. Launch a sales effort to get more large commercial contracts. He analyzes each as an investor. For the design service, the ask is $10,000 for new software and training. The projected return is $50,000 in new profit in the first year. The ROI is 400%, and he gives it a certainty score of 8 out of 10. For the organic package, the ask is only $2,000 for new marketing materials. The projected return is $15,000 in profit. The ROI is 650% with a certainty score of 9. For the new commercial contracts, the ask is significant time from him personally, but only $3,000 in marketing costs. The potential return is $60,000 in profit, but it is highly dependent on landing 1 or 2 big contracts, so he gives it a certainty score of only 5. When he ranks them, the organic lawn care package is the clear winner. It offers a massive ROI with very high certainty and a low initial investment. The landscape design service is a strong number 2. The commercial contract push is a distant third due to its lower certainty. He makes his decision. He will immediately fund the organic package and the design service, and he will put the commercial contract push on the back burner for now. He has just made a disciplined, strategic capital allocation decision. You now have a disciplined system for deciding where to invest your precious resources. But all investments are not created equal in their ability to grow your business. Some investments produce linear returns, while others can produce exponential, scalable growth. How do you identify the specific types of investments that will allow your business to break free from incremental improvement and achieve true scale? In the next chapter, we will delve into the 4 key levers of scalable growth and explore how the investor-minded founder funds them. Remember to subscribe to Success Attraction Formula, give this video a like, and comment with your personal opinions or suggestions for channel development. Chapter 4. Funding the Levers of Scalable Growth. Imagine 2 different ways to increase the amount of water flowing from a garden hose. The first way is to grip the faucet handle and turn it a little harder, forcing more water through the same narrow opening. The output increases, but only in direct proportion to the effort you exert. The second way is to leave the faucet as it is and instead replace the standard spray nozzle with a massive fire hose nozzle. With the same amount of water pressure from the source, the output is now exponentially greater. This is the difference between linear growth and scalable growth. The problem is that most founders spend their entire careers focused on turning the faucet handle. They invest their capital in things that produce linear returns. They hire 1 more salesperson, which results in a few more sales. They spend a little more on advertising, which brings in a few more website clicks. Their growth is directly and inextricably tied to their inputs of time and money. To grow by 10%, they must spend 10% more. They are trapped in a linear model, working harder and harder for incremental gains. They fail to see that the real game is not about turning the handle harder, it is about changing the nozzle. They fail to identify and fund the true levers of scalable growth, the specific types of investments that allow a business to grow much faster than its inputs, creating a nonlinear exponential trajectory. The transformative solution is to begin thinking not like a small business owner, but like a venture capital investor. The entire venture capital model is built on one single premise: finding and funding businesses that have the potential for massive, scalable growth. They are not interested in businesses that grow linearly. They are looking for businesses that can use capital to install a fire hose nozzle. The investor-minded founder must adopt this same perspective. You must learn to differentiate between investments that simply make your business incrementally bigger and investments that fundamentally change its growth potential. The core mindset shift is from asking, "How can I grow my business?" to asking the far more powerful question, "How can I build a business that is capable of growing itself?" This requires you to allocate your investment capital with a specific focus on the key levers that decouple your company's growth from your personal time and from a linear increase in expenses. It means consciously investing in assets that, once built, can serve 10, 100, or 10,000 customers with very little additional cost. This is the path to breaking free from the trap of incrementalism and building a truly scalable enterprise. There are 4 primary levers of scalable growth that the investor-minded founder must learn to identify and fund. The first and most foundational is technology and automation. In any business, there are countless manual, repetitive tasks. Investing in technology to automate these tasks is a powerful lever. This allows your business to handle a vastly larger volume of work without a corresponding increase in your headcount. It is about strategically replacing expensive, linear human labor with infinitely scalable software wherever possible. This could be as simple as implementing an automated email marketing system instead of sending emails one by one, or as complex as building proprietary software to manage your entire customer workflow. Every process you automate is a step toward scalability, allowing you to serve 10 times the customers with the same core team. The second lever of scale is audience and brand. A business that has to pay for every new customer it acquires through advertising is on a linear growth treadmill. A business that has a direct, trusted relationship with a large audience has a priceless, scalable asset. Investing in building an audience, whether it is through an email list, a YouTube channel, a podcast, or a vibrant social media community, is one of the highest return activities a founder can undertake. An engaged audience is an asset that allows you to launch new products and market your services at a near zero marginal cost. Similarly, investing in building a strong, trusted brand creates a scalable advantage. A strong brand lowers your customer acquisition costs, allows you to command premium pricing, and builds a moat of loyalty that is difficult for competitors to overcome. This is not a short-term investment, but it is one that pays exponential dividends over time. The third lever is intellectual property and productization. This is the critical lever for any founder whose business is currently based on providing a service. A service is fundamentally unscalable because it requires a one-to-one delivery of your time. You can only serve as many clients as you have hours in the day. The key to scalable growth is to invest in productizing your service. This means taking your knowledge, your methodology, and your unique process and turning it into a product that can be sold one-to-many. This could be an online course, a book, a software tool, a standardized workshop, or a licensed system that other people can use. By creating this piece of intellectual property, you decouple your revenue from your time. You build it once and you can sell it an infinite number of times, allowing your income and impact to scale in a way that providing a service never could. The fourth and ultimate lever of scale is network effects. This is a powerful phenomenon where a product or service becomes more valuable as more people use it. A telephone is useless if only one person has one, but its value grows exponentially as more people join the network. Modern examples include social networks like Facebook, marketplaces like Airbnb, and collaboration software like Slack. Investing in building features or business models that create network effects is the holy grail of scalable growth because it creates a powerful, self-reinforcing loop. More users make the product better, which in turn attracts even more users. This creates a powerful competitive advantage, often leading to a winner-take-all dynamic in the market. While not every business can have true network effects, thinking about how you can create a community or ecosystem around your product can be a powerful way to build a scalable moat. Let's look at an example. A highly successful business consultant is making a great income, but she has hit a ceiling. Her business is unscalable because it is 100% dependent on her personal time delivering one-on-one services. To grow, she must learn to fund the levers of scale. First, she invests in technology, implementing a sophisticated customer relationship management system to automate her follow-ups and client communication. Second, she invests heavily in audience, starting a weekly podcast where she shares her expertise. Over a year, she builds a loyal following of thousands of potential clients. Third, and most importantly, she invests in productization. She spends 6 months and a significant amount of capital to turn her signature consulting methodology into a high-quality, self-paced video course. Now, instead of serving only 10 clients a year, she can sell her course to thousands of people around the world. Her business is no longer linear, it is scalable. She has transformed her job into a true asset. You have now learned how to allocate your capital and how to specifically fund the levers that create scalable growth. The result is a business that is getting bigger, faster. But growth alone can be a trap. Is it profitable growth? How do you ensure that as your company scales, its profitability scales with it? In the next chapter, we will explore the investor's playbook for achieving peak profitability, ensuring your growing business is also a financially healthy and resilient one. Remember to subscribe to Success Attraction Formula, give this video a like, and comment with your personal opinions or suggestions for channel development. Chapter 5. The Investor's Playbook for Peak Profitability. There is a classic saying in the world of business that every founder should carve into their desk: revenue is vanity, profit is sanity, but cash is king. This simple phrase contains a universe of wisdom. Yet, a vast number of entrepreneurs operate in direct violation of it. They fall into the trap of chasing growth at all costs. This is the pervasive problem of the growth trap. Founders become obsessed with the top-line revenue number, that single, seductive figure that makes them feel successful. They chase any sale, no matter how small the margin. They offer deep discounts to close a deal. They take on complex, unprofitable work just to see the revenue number tick upward. In this relentless pursuit of vanity, they completely lose sight of sanity. They fail to manage their expenses with discipline, they fail to price their products based on value, and they fail to manage their cash flow effectively. The result is a business that can look impressive from the outside. It might be growing fast, hiring people, and getting media attention, but on the inside, it is dangerously unhealthy. It is a bigger business, but it is actually a worse business, constantly starved for cash and perpetually one bad month away from disaster. This is not a path to wealth. It is a path to burnout and bankruptcy. The transformative solution is to adopt the investor's obsession with profitable growth. The investor-minded founder understands that the ultimate goal is not just to build a large company, but to build a profitable and resilient one. The core mindset shift is from acting like a salesperson, whose only goal is to increase revenue, to acting like a disciplined business operator, whose goal is to increase the bottom line. This means you must master the mechanics of profitability. You must become a student of your profit margins. You must understand your unit economics with precision, and you must manage your cash conversion cycle with the focus of a hawk. An investor does not just look at a company's revenue growth. They scrutinize its margin trends and its cash flow statements, because these are the true indicators of a healthy, sustainable business. By applying this same investor's discipline to your own operations, you can ensure that as your company scales, its financial strength scales along with it. You will be building a business that is not just growing, but is also creating real, durable wealth. To implement this playbook for profitability, there are 4 key areas you must master. The first is to master your margins. It is not enough to know your overall gross margin. You must understand the specific contribution margin of every single product or service you offer. The contribution margin is the revenue from a product minus its variable costs, and it tells you how much each sale contributes to covering your fixed costs and generating profit. When you analyze your business at this level, you will almost certainly find that some of your products have fantastically healthy margins while others are frighteningly thin. The investor's playbook demands that you take action on this data. You must relentlessly focus on increasing the sales of your highest margin products and have the courage to either raise the prices on or eliminate your lowest margin offerings. You must also constantly look for ways to reduce your variable costs without sacrificing quality, thereby increasing the margin on every sale you make. The second area to master is your pricing strategy. This is one of the most powerful and often underutilized levers for increasing profitability. Most founders, particularly those with service businesses, dramatically underprice their offerings. They are afraid that if they raise their prices, their customers will leave. An investor knows that pricing is a strategic tool to be tested and optimized, not a number to be set once and feared forever. You must move away from simple cost-plus pricing and toward value-based pricing. This means setting your price based on the return on investment and the value you deliver to your customer, not on the hours you spent or the costs you incurred. You should also strategically test different pricing models. Could you offer a premium, high-priced tier of your service? Could you bundle products together? Could you shift from one-time sales to a recurring subscription model, which dramatically increases customer lifetime value and predictability? A small strategic increase in your average price can often have a more dramatic impact on your bottom line than a massive increase in sales. The third and most advanced area of mastery is the cash conversion cycle. This is a critical metric that measures the amount of time it takes for a dollar you spend on your business, for example on inventory or employee salaries, to make its way through your operations and back into your bank account in the form of a customer payment. The shorter this cycle, the more cash efficient your business is. The investor-minded founder is obsessed with shortening this cycle. There are two primary ways to do this. First, you must collect your accounts receivable, the money owed to you by customers, as quickly as possible. This means invoicing immediately, offering discounts for early payment, and having a clear process for following up on late payments. Second, you must manage your accounts payable, the money you owe to your suppliers, as strategically as possible. This means negotiating longer payment terms with your vendors, allowing you to hold on to your cash for a longer period. The ultimate goal is to achieve a negative cash conversion cycle, where you collect cash from your customers before you have to pay your suppliers. This is a hallmark of some of the world's most cash-efficient businesses, and it is a powerful engine for self-funded growth. The fourth practice is a simple but powerful habit called profit first. This concept, popularized by the author Mike Michalowicz, turns the traditional accounting formula on its head. Instead of the formula being sales expenses equals profit, it becomes sales profit equals expenses. In practice, this means that every time you receive a payment from a customer, you immediately transfer a predetermined percentage of that money, say 10%, into a separate bank account dedicated solely to profit. The money that remains is what you have available to run the business. This simple act forces a discipline of profitability. It ensures that you are paying yourself and your business first, and it forces you to find ways to run your operations more efficiently with the cash that is left over. It is a powerful psychological and practical tool for ensuring your business is profitable by design, not by accident. Let's look at a freelance marketing consultant who is growing her revenue but is always feeling cash-strapped. She decides to apply the Profitability Playbook. She analyzes her margins and realizes that her monthly retainer clients are far more profitable than her one-off project clients. She optimizes her pricing by creating a new premium tier retainer with a higher price point and phases out her project-based work. She manages her cash flow by changing her payment terms from net 30 to requiring a 50% deposit up front and the final 50% upon completion. Finally, she opens a new bank account and starts transferring 15% of every single payment into her profit account. Within 3 months, her business is not only generating more profit, but for the first time, she has a healthy cash reserve, giving her a sense of security and freedom she has never experienced before. You are now growing your business scalably and profitably. You are building a powerful, healthy enterprise. But what is the ultimate endgame? How do you ensure that the business you are building has real transferable value in the long term? What is the final perspective of the investor-minded founder? In our last main chapter, we will explore the critical discipline of maximizing your long-term enterprise value, the ultimate goal of the founder's wallet. Remember to subscribe to Success Attraction Formula, give this video a like, and comment with your personal opinions or suggestions for channel development. Chapter 6. Maximizing your long-term enterprise value. What is your business truly worth? This is perhaps the most important and most poorly understood question in the world of entrepreneurship. It is not about what you think it is worth or what you hope it is worth based on your years of hard work. The real question is, what would a rational, objective, outside buyer be willing to pay for your company as a financial asset today? The problem is that most founders are building businesses that are valuable to them, but not necessarily valuable to anyone else. They are so focused on the day-to-day operations and on generating their own personal income that they fail to make the strategic decisions that build real, transferable, long-term enterprise value. They build companies that are completely dependent on their own personal involvement, that have unpredictable revenue streams, and that lack any discernible competitive advantage that a buyer could acquire. They are, in essence, building a high-paying job for themselves, not a valuable, sellable asset. This severely limits their future options. Whether they hope to one day sell the company for a life-changing sum, raise capital from outside investors, or simply pass the business on to the next generation, their choices are constrained because they have not been building with the end in mind. The transformative solution and the ultimate goal of the investor-minded founder is to consistently make decisions through the lens of maximizing the long-term, transferable enterprise value of your company. This requires a final, crucial mindset shift. You must move from thinking, "How can I increase this year's profits?" to asking the more sophisticated question, "How will this decision affect the multiple of profit that a future acquirer would be willing to pay for my entire business?" An investor does not just value a company based on its current profits. They value it based on the quality and predictability of those profits. A business with stable, predictable, and growing profits will command a much higher valuation multiple, sometimes 3, 5, or even 10 times higher, than a business with volatile, unpredictable profits of the exact same amount. By focusing on the specific drivers that increase this valuation multiple, you are not just building a profitable company, you are building a truly valuable asset. This is the final and most profound expression of thinking like an investor in your own company. There are 4 primary drivers of enterprise value that you must focus on building. The first, and arguably the most important, is the proportion of your revenue that is predictable and recurring. A business that relies on one-time, project-based sales is inherently volatile and risky in the eyes of an investor. A business that has a large base of customers on long-term contracts or monthly subscriptions is stable, predictable, and incredibly valuable. An investor will pay a massive premium for predictable cash flow. Therefore, a core strategy for maximizing your enterprise value is to find ways to build recurring revenue models into your business. This could mean turning a product into a subscription service, creating a membership program, or offering long-term service contracts. Every dollar of recurring revenue you create is worth many times more than a dollar of one-time revenue in the eyes of a buyer. The second key driver of value is customer diversification. If a single client accounts for 40 or 50% of your revenue, your business is extraordinarily risky. If that client leaves, your business could be destroyed overnight. An investor sees this customer concentration as a major red flag and will dramatically discount the value of your company as a result. The investor-minded founder works diligently to diversify their customer base. They actively seek to ensure that no single client represents a dangerously large portion of their total revenue. This may sometimes mean turning down a huge project from an existing large client in favor of acquiring several new, smaller clients. This might seem counterintuitive to short-term profit, but it is a brilliant move for building long-term, resilient enterprise value. A business with a broad and stable customer base is a much safer and therefore much more valuable asset. The third driver of value is the creation of an owner-proof business. A company that is completely dependent on the founder's personal involvement, skills, and relationships has very little transferable value. If the founder leaves, the business collapses. An investor is not buying a job for themselves. They are buying a self-sustaining system. This is the ultimate payoff from the work you did to create systems and processes. A business with well-documented operating procedures, a strong second-tier management team that can run the day-to-day operations, and clean, organized financial records is a valuable, sellable asset. A business that exists only in the founder's head is not. The ultimate goal is to build a company that would not only survive, but continue to thrive if you were to take a 6-month vacation. That is the sign of a truly valuable and well-managed enterprise. The fourth and final driver of value is the strength of your durable competitive advantage, often referred to as a moat. What is it about your business that makes it difficult for a competitor to replicate your success? A deep and defensible moat will command a very high valuation multiple. This moat could be your strong brand, which creates customer loyalty beyond your product's features. It could be your proprietary intellectual property, like a unique software algorithm or a patented design. It could be the network effects you have built, where your platform becomes more valuable as more people use it. Or it could be deeply embedded customer relationships and high switching costs that make it difficult for your clients to leave. The investor-minded founder is constantly thinking about how to widen their company's moat, making strategic decisions not just for short-term gain, but to build these long-term defensible advantages. Consider 2 identical consulting firms, each generating $200,000 in annual profit. The founder of Firm A runs it as a job. He pays himself a high salary, all his clients are on a project-by-project basis, and he is the only one who can do the work. The founder of Firm B thinks like an investor. She reinvests her profits. She transitions her clients to annual retainer contracts, creating recurring revenue. She diligently acquires new clients to ensure no single one dominates her portfolio. She documents all her processes and hires and trains 2 other consultants to handle the day-to-day client work, making the business owner-proof. A potential buyer might value Firm A at 2 times its profit, or $400,000, because it is essentially just buying the founder's job. But they would see Firm B as a true asset and might value it at 5 times its profit, or $1 million, because it is a stable, scalable, and transferable business. The founder of Firm B focused on enterprise value, and in doing so, created far more real wealth. Thinking like an investor is not about being greedy. It is about being a responsible steward of the enterprise you're building. It is the commitment to creating something of real, lasting, and transferable value, an asset that can provide security and freedom for you, your team, and your family for many years to come. We have now traveled the complete journey of the investor-minded founder. It is a path that starts with a fundamental change in perspective, viewing your company not as your baby, but as your most important financial asset. This new lens then guides you through a disciplined process of auditing your assets and risks, allocating your precious capital to the opportunities with the highest return, and strategically funding the levers that allow for scalable, profitable growth. The final and highest expression of this philosophy is to consistently make decisions that maximize the long-term, transferable enterprise value of your company. This is not simply a collection of financial tactics. It is a holistic and powerful operating system for building a business that is not only successful in the short term, but is also a source of enduring and meaningful wealth in the long term. Thank you for joining us for this masterclass in thinking like an investor in your own company. We hope this playbook has equipped you with the mental models and strategic tools to transform your business into a powerful, profitable, and valuable asset. Building a truly valuable enterprise is the result of disciplined, deliberate choices, and the power to make those choices is now in your hands. If you found this content insightful, please support our channel by giving this video a like, subscribing to Success Attraction Formula for more frameworks on building wealth and success, and leaving a comment below to share your own experiences. Your engagement is what fuels our mission.